So you don't need to be an accountant to run a really successful, profitable business, but you do need to understand your numbers. And I'm not talking about jargon type numbers. I'm not talking debits and credits and spreadsheets and accruals and prepayments. And I'm not talking about the accounts that you look at whenever your year end has passed and gone and that you use to determine how much tax you're going to pay and pay that and then put it away for the next year. I'm talking about real numbers that you can use and that every business owner should be monitoring and tracking on a regular basis to help make better decisions about the running of your business. So let's look at the first one. So first of all, the most important one really is your gross profit margin. And your gross profit margin basically tells you how much profit you make on on your core products and services before overheads. Now overheads obviously are the static costs of your business. It might be heat, light, power, advertising, marketing, some fixed salaries, telephone, internet, things like that. So the formula is simple. It's gross profit divided by turnover as a percentage. Gross profit is your sales minus the cost of sales. That's what gives you the gross profit. How to benchmark? It does depend on industries. Higher gross profit margin is better. You could look at some industry standards and benchmark yourself against those. So for example, let's look at, you sell a service for £10,000. It costs you £6,000 to deliver it with any materials you need that are direct costs of sales, any freelancers, any wages and so on. And your gross profit therefore is 4,000. So to get your gross profit margin, that's 40%. It's that 4,000 divided by the 10,000. So it's as simple as that. Why does it matter? Well, if you're tracking that on a regular basis and your margin starts to drop, you know that either your pricing needs to be looked at, you need to increase your prices, or perhaps you need to look at your suppliers because that cost base is creeping up. So it tells you whether you are pricing things correctly. And it helps you spot any rising costs before it really starts to impact. It's really essential if you want to scale, because there's no point in selling more of something with a terrible margin. And one of the first things that we would ask clients to look at is that margins per product or service line, so we can concentrate on selling the things that make most money for you. And it's really, again, important to understand the difference between turnover and profit, because I've seen too many great salespeople sell themselves into trouble. If you track it monthly, therefore, if it starts dipping, something's up. So analyse what's up and make those changes accordingly. It's also really important because it helps you, well, without it, you can't calculate your break-even point and put in a plan in place to generate revenue and profit growth. So that brings me on to number 2, your break-even point. Now, I know I've got videos that go into this in a lot more detail, but just as a quick reminder and a quick overview, your break-even point is essentially your fixed costs divided by your gross profit margin. So another simple example then, say if your fixed costs are £10,000 per month and your gross profit margin is 50%. It's just easy for me to work out in my head. That means that 10,000 divided by 50% is £20,000. So you need £20,000 per month in order to break even. Now, that means that therefore, assuming this is the same, which it should be, your annual break even is £240,000. Weekly break even is 4,616 or a little under, and your daily break even is 658, assuming your business is open every single day, every single week. You know, if you have times where you close down the business, you might want to work that out based on the number of weeks you're open and 5 days a week rather than 7 days a week, for example, if you're delivering a service. Again, benchmark your industry. It's really, really critical, and you want to work this out on that monthly or weekly or even daily basis, so you know how much it costs just to open the doors every single day. Without this, it's quite easy to become overwhelmed about how big a target you might have and also not understand what's going wrong. So just a tweak in that profit margin can help reduce the break even. If you can increase the profit margin, you reduce the number of units you need to sell in order to break even. Likewise, if your margin drops, you could be in real trouble without realising it. And why is it important? Well, you need to know how much you need to sell to keep the doors open, but also, if you've got goals and dreams and ideas, this helps you figure out how much more you need to sell to make that key higher, to bring somebody new on board, to move premises if you need to, or maybe even to take a little bit more money out for that special holiday or for a pension contribution, depending on what's important to you. So that's the second one, calculating your break even. Third is, well, it's called a current ratio, which is much more sort of jargon type of name, I think. But basically it means that you can pay your bills on time. So the formula is current assets divided by current liabilities. So assets are something you have, liabilities are something you owe. So for example, you've got 20 grand in the bank and you've got £10,000 that's owed to you in debtors. So that's £30,000 either in your bank right now or should be coming into you. And you owe £15,000 out for maybe VAT, suppliers, payroll, whatever that might be. So that means your current ratio is 30,000 divided by 15,000, which gives you a figure of 2. So what does that mean? What does the figure of 2 mean? Well, anything below 1 is a red flag. So anything below 1 means that you don't have enough liquid assets to be able to pay your short-term debts. So this is a real indicator of the short-term health of a business. So ideally you want to be somewhere between 1.5 and 2.5. This is not a case of the higher the number the better. So actually if your current ratio is too high, that's an indication that you're just not reinvesting in your business, or you've got too much cash sitting there idle and it's not doing anything for you. It's not earning interest, it's not being reinvested into marketing, it's not being used to maybe make a big pension contribution for you or to be put into staff training to improve what you're doing, or even just to be paying yourself more tax effectively. This is also one of the first things that any bank or investor will look at. So it's really important you understand it and you monitor and track that. And then fourth and finally, debtor days. So it's also sometimes called receivable days. We used to refer to it as DDOs, debtor days outstanding. And why is this important? Well, basically this is the speed at which, how long it takes you to get paid. So the formula for that is debtors divided by turnover times 365 days in a year. Obviously 366 if it's a leap year. So again, for example, if you're owed £30,000, your annual turnover is £300,000, then debtor days are 30 divided by 300,000 times 365, and that brings you out at 36.5 days. Different industries have different standards. You may see construction industry saying their general payment terms are 90 days or 45 days, but really if your debtor days are higher than 30 days, you're starting to bankroll your clients. And why does it matter? Well, the longer you take to get paid, the more pressure there is on your cash flow. So if you're paying staff on a weekly or even a monthly basis, and you're paying suppliers on time, but you're waiting 45 to 60 days or even 90 days at worst to get paid yourself, then you're having to find a way to bridge that gap. And again, it's money that you could be using to build and grow your business in a different way. So it's really important to get on top of your debtor days. The ways you can sort of improve this is just by having really clear payment terms and making it easy for clients to pay, automating your invoice reminders if you use something like Xero, and just being really tough on, it's your money. And remember, a sale isn't a sale until the money's actually in your bank account. Doesn't matter if they've signed a contract, doesn't matter. If you never get paid, that's not a sale that's been made. And that has a massive impact on everything else that we've just talked about above. Okay, I think that's that. I'm going to stop here and I can answer any questions below, and I can also do a bit more in depth on any other ratios you want to see explained, or on any of these if you want me to do a deeper dive onto them. But understanding these ratios, all four of them, it really does give you a superpower compared to many, many business owners out there. You can spot problems early, you can make decisions faster, and you can grow your business with confidence. And if you'd like any help with tracking any of these, or if you'd like help setting up a simple dashboard so you can track them yourselves, then we'd love to help. So get in touch. I look forward to hearing from you, and bye bye from now.